Chapter 15, Brief Summary. In Chapter 15, we'll be talking about job order costing. So if we take a look at the slides, we can see that we're going to be talking about a costing system. So the purpose of a costing system is to figure out how much something costs. So remember from Chapter 14 that every product has three different types of costs. And these costs are direct materials, direct labor, and manufacturing overhead. In this chapter, we're going to introduce two types of costing systems, process costing and job order costing. Now, the difference between the two is that process costing is when you make the same product over and over again, and every product has the same number of steps. So for example, in process costing, on this slide, you can see that they're making potato chips. So every bag of potato chips is the same as every other bag. We're just going to assume that this company only makes one type of potato chips and they make only one size. So you can see that process costing would make sense if you have a product that's made continuously. It's always the same every time. What about if you have products that are different each time? In this example, you're making a movie. So every movie is different. So every movie is going to need different actors. Every movie is going to need different number of people producing the film. Every film might be a different length. So in this case, you would want to use job order costing. You can see at the bottom of the slide, it says each job has distinguishing characteristics and related costs. Since this chapter talks about job costing, let's take a look at this flowchart. In this flowchart, you can see that everything is moving from left to right. So you have manufacturing cost on the left, and then when you work on something, it becomes part of work in process. Work in process means something that has been produced but is not finished yet. Next, you have finished goods inventory. And finally, when you sell finished goods inventory, it becomes cost of goods sold. This is an extremely important chart, and the way this chart works is as follows. So we have raw materials, we have factory labor, and we have manufacturing overhead. So you can see for raw materials, we have direct materials, that's number 4. So direct materials go into work in process, and indirect materials, look at where the arrow is going, indirect materials go into manufacturing overhead. Factory labor is made of two things. There's two ingredients in factory labor. There is direct labor, so that's number 5. So you can see for direct labor, that goes into here. Indirect labor goes into here, right? Then manufacturing overhead, when you start making something, look at number 6. That goes into work in process. Okay, so you can see the flow of everything. What happens when you finish making something? Then it should leave work in process, that's 39,000, and then it becomes part of finished goods inventory. What happens if you sell something? If you sell something, then it's going to leave finished goods inventory, and it's going to become part of cost of goods sold. So you can use this flowchart to help you figure out journal entries. Look at this journal entry here. It says Wallace uses $24,000 of direct materials and $6,000 of indirect materials. What would be the journal entry? Notice that we debit work in process, we debit manufacturing overhead, and you credit raw materials. Let me explain why. It says that Wallace is using materials, direct materials, and they're using indirect materials. Okay, so they're using direct and indirect materials. Let's go back here. When you use materials, look at number 4. When you use materials, it's going to leave raw materials, and some of it goes here, and the other part goes down here. What part goes here? That would be your direct materials. What part goes down here? Well, down here it's indirectly going here, so it goes into indirect materials. If I use materials, what would I debit and what would I credit? Look at number 4. Look at this. It says for number 4, you would debit work in process. See here, it's at the top of the T account. You would debit manufacturing overhead. And then what's on the credit side here? You would credit raw materials inventory. That's the journal entry that you have here. So the flow chart is extremely, extremely important. Make sure you take a look at that. And again, this is another depiction of the flow chart. Okay, lastly, we're going to talk about a predetermined overhead rate. So what happens is that manufacturing overhead is not really known until the end of the year. So manufacturing overhead includes things like property taxes, it includes factory depreciation. Those types of costs are not really known until the end of the year. But we need to figure out some way to estimate how much they're going to be during the year. So we call that a predetermined overhead rate. So you can see here that the formula for predetermined overhead rate is estimated annual overhead cost divided by estimated annual operating activity. That's the predetermined overhead rate. And we use the rate to assign it to different products. So we can figure out the predetermined overhead rate by taking estimated overhead divided by some estimated cost driver. And that's going to give you the predetermined overhead rate. Okay, it's 80 cents or 80% here. Okay, so this is an example which you can look at yourself, but I want to show you in more simple terms how you can figure it out. Okay, so let's say that estimated manufacturing overhead is $1,000. Okay, so at the beginning of the year, I think that I'm going to have $1,000 in overhead. May not be 1,000, but that's what I think. And then we have to use some kind of cost driver. Cost driver means that if you have more cost driver, you have more overhead cost. Let's say that we think we're going to have 500 labor hours. Okay, so cost driver can be anything. Cost driver can be labor hours. Cost driver can be direct labor cost. Cost driver can be machine hours. Right? Those are some examples. But in this example, let's pretend that I estimate at the beginning of the year that I'm going to have $1,000 in overhead, and my estimated cost driver is 500 labor hours. Now, when it comes to a cost driver, they always have to tell you what it is. Okay, so you don't have to guess. They have to tell you in the problem. All right. Now, let's say that my actual labor hours was 200. Okay. So what is the estimated manufacturing overhead? Okay, so here's what we do. The question is asking, how much overhead are we going to estimate that we have during the year? Now, it's not 1,000, because 1,000 is what we estimated like at the beginning of the year, based on what happened in the past. That doesn't mean that that's what we actually have this year. So how much did you have this year? How much did you estimate, or how much did you apply? Well, I think I'm going to have $1,000 in overhead. I think that because that's what I figured out before. At the beginning of the year also, I figured that I think I might have 500 labor hours. So if you do the math here, that equals $2 per labor hour. Okay, so this is called a predetermined overhead rate. Okay, so that means we figure this out at the very beginning, and then during the year, how many labor hours did we actually have? We actually had 200 labor hours. Okay, so what is the manufacturing overhead applied? Like, how much are we going to put in our books? Well, the predetermined overhead rate is $2 times how many actual hours did we have? What did we have actually? Well, we had 200 hours actually. So how much overhead am I going to apply? That means how much overhead am I going to put down in my books? It's going to be $400. Okay. Now, what if at the very, very end of the year, manufacturing overhead was actually $450? Okay, so we would only know this number at the very, very end of the year when we count up all of our receipts and everything. So we actually had $450 in overhead, but we thought we were only going to have, or we applied $400. So did we over apply or did we under apply overhead? Well, we applied 400, but it was actually 450, so we did not apply enough. So it's under applied. And it's under applied by, what's the difference between these two numbers? $50.